Hello everyone, my name's Elliot Gu. I'm founder of Capitalist Times Investment Research and the founder and chief market strategist of the Creating Wealth Advisory. Now, as many of you are very well aware, the Delta variant of coronavirus has been making a lot of headlines recently. In fact, on Wednesday, August 4th, 2021, there were a total of 17,701 news stories in Bloomberg's database of multiple different media sources from around the world that mentioned the word Delta. And that's up, as you can see on this chart right here, for around 2,000 stories a day back in May, all the way up to nearly 18,000 just last week. So the big question on everyone's mind is the more easily transmissible Delta variant of coronavirus likely to short circuit the powerful market rally underway for more than a year now? And is it likely, in fact, to derail the U.S. and global economic recoveries? Now, that's kind of been the subtext of recent trading action in both equity and bond markets. So you might say, well, the stock market's been making a series of fresh all-time highs, so certainly that's not showing any weakness or any signs of distress about the economic environment. But the fact is, equity markets really are showing signs of distress. So since the June 8th peak of the New York Stock Exchange cumulative advanced decline line, which is a measure of market breadth that I'll show you here in just a minute, the S&P 500 is up more than 5.1% since June 8th. So up a little more than 5%. Not bad for a summer rally over roughly a 2-month period. And of course, as you are all very well aware, it has logged a series of fresh all-time highs. However, that rally has not been broad-based. In fact, that rally has been led by just a small handful of large-cap growth stocks. While the economy-sensitive cyclical stocks in the Russell 1000 Value Index, these would be stocks in groups like industrials, energy, and financials, they have lagged. So the Russell 1000 Growth Index is up more than 9.9%. So it's up nearly 10% since June 8th. But the Russell 1000 Value Index is up just 0.1%. So that's nearly 10 percentage points of outperformance for growth stocks over value stocks over just less than the past 2 months since June 8th. So this is almost a record-setting outperformance of growth over value over just a 2-month holding period. And what that reflects is investors are hiding, if you will, in these more defensive growth stocks, these stocks that don't need help from the broader economy to show earnings and sales growth. And they're avoiding or shunning a lot of the more cyclical value stocks like banks, energy stocks, industrials, etc. Even worse, the so-called reopening stocks have been hit even harder. So you have names like American Airlines, obviously a big airline company. That's down 13.7% since June 8th alone. A company like Avis Budget Group, which is a car rental agency, they're down 8.9% since June 8th alone. Now, of course, amid all these jitters about the coronavirus, all the media feeding frenzy about coronavirus, again, 18,000 stories in one day nearly last Wednesday, August 4th, you've seen a lot of investors flock, apparently, to the safety of the U.S. Treasury market. So the yields on 10-year U.S. government bonds are actually down from around 1.6% at the end of May and highs near 1.75% earlier this year, all the way down to under 1.2% earlier on this month, in the month of August 2021. So is Delta going to derail the market? Is the Delta variant going to cause investors to run back to the safety, the relative safety of very expensive growth stocks, just as they have on several occasions over the last several years? In fact, just last summer, we saw that very same trend. In my view, that's not going to happen. In my view, in fact, the risks from the Delta variant are overblown, and the rotation in favor of value and cyclical stocks that was underway up until June of this year, I believe it's going to resume at some point in the next 3 months. And that's also going to spell trouble for growth stocks. Now, of course, I should preface that prediction with a major caveat, and this is crucial. In the financial markets, being early on a trend is the same as being wrong. In fact, I advise and for some of you may find this advice almost the opposite of what you're hearing from a lot of other pundits out there. But in my opinion, you should always, as an investor or a trader, you should always react, not anticipate. And the reason is, of course, because being early to a trend is the same thing as being wrong. If you think there's 1,000 reasons for the market to go down over the next 12 months, I believe you're right. There's a lot of reasons why the market could go down over the next 6 or 12 months. But the fact is that doesn't do you any good if you start shorting the market or betting against further upside or not buying into the stock market if it continues to rise for the next 6 months and only then falls from much higher levels. Just ask anyone who was short the S&P 500 or even worse, the NASDAQ 100 back in 1998 or 1999. That was a bubble. Eventually it did crash, but it crashed from much higher levels starting in March of 2000. So I do not recommend positioning aggressively in your portfolio for a rotation this year back into value until I have clear evidence in the indicators, and I'm going to show you a few of them here in just the next few minutes, that rotation is underway again. But I do believe it will happen at some point over the next 2 to 3 months by the end of October. Now, earlier this week, and I want to move back now to the Delta variant and why I don't believe it's all it's hyped up to be. Earlier this week, I read several research reports that seemed bound and determined to show some impact on U.S. consumers from the rapid growth in Delta variant cases. And while it's always possible to stretch and manipulate statistics to support just about any desired hypothesis, I just don't see it in the real data. And let me show you what I'm talking about here on this next chart. Now, what this is OpenTable, which many of you know is a restaurant reservation system. In fact, it's the largest in the United States, the largest in the world. They provide data showing how many people in various states, countries, the U.S. as a whole, are booking tables through their system and then sitting down to dine in a restaurant. Now, this is important because obviously restaurants are one of the most impacted parts of the economy to coronavirus-related fear and restrictions. And what I've done here is I've plotted the 7-day moving average of the change in seated diners for 4 different states in the United States, the largest 4 states in the U.S., which is California, Texas, Florida, and New York. And I'm showing you the change in seated diners, not versus 2020, but versus 2019 levels, the same 7-day period in 2019, which was before the coronavirus outbreak. And what you can see here, I think is a very interesting trend. First up, let's look at Florida, which is in blue, and Texas, which is in that orange color. Now that would be the second and the third largest states by population. So Texas number 2, Florida number 3. Both of those states have seen widely publicized surges in positive coronavirus tests. And ostensibly that's been driven by the Delta variant. That's the dominant variant of coronavirus, the dominant strain of coronavirus, whatever you want to call it, in most U.S. states. However, people just aren't reacting to the coronavirus outbreak this summer anything close to the same manner as they did amid a surge in coronavirus cases in the summer of 2020. In Florida, for instance, OpenTable reports a 12.15%, and you can see that here, again, that's the blue line, average increase in seated dining reservations over the last 7 days compared to 2019. So even amid all the talk of Delta variant, amid all the talk of the federal government recommending masks again indoors, even for those vaccinated consumers, seated diners in Florida are still up more than 12% from where they were in 2019 before the coronavirus outbreak. So people are still eating out. And I got to tell you, I live in Florida. It's pretty hot this time of year, right in the middle of the dog days of August, dog days of summer. And a lot of those seated diners are inside. And in fact, restaurants are packed here in Florida. Much the same can be said of Texas. A little bit slower increase over 2019 levels, but still very, very strong despite all the talk of the recent frenzy around the Delta variant. Now, on the flip side of the coin, we have California in gray, and we have New York State, not city, but New York State, which of course is the largest, California, and the fourth largest state in the U.S. by population, New York. And these two states have generally adopted a more draconian approach aimed at controlling the coronavirus outbreak generally since the beginning of the outbreak back in 2020. And both states have seen an increase in the number of positive tests lately, but the scale of the surge in the Delta variant hasn't been as large in California or New York as it has been in Florida and Texas lately. However, just look at that open table data and you'll see two key points. First of all, seated diners in both California and New York are both down significantly below zero relative to 2019 levels. And they never recovered. This data goes back to the beginning of 2021. They've never recovered to the degree that Florida and Texas have seen. And secondly, the trend in seated dining reservations compared to 2019 has been relatively flat for all four states relative to their own histories since early June, despite varying experiences with the Delta variant and with the state government's response to the outbreak. So you can see that really Florida and Texas have been holding up in terms of seated diners versus 2019 all summer long, well above zero, and kind of trading sideways. Of course, you've had little bump ups around holidays, for example, but pretty much trading sideways since May. The same is true in both California and New York, though, of course, both those states are down relative to 2019 levels because they still have more stringent coronavirus-related containment policies in place. They're still, relative to their own history, pretty flat from where they were in May and June. Listen, I'm not an epidemiologist, and I'm definitely not a doctor. I have absolutely no desire to study viruses or viral transmission rates, or try to opine on whether masks are good or bad, or whether they're necessary or not necessary, or even to tell you about vaccines. But I can read a chart. Now, perhaps it's down to fatigue on virus containment restrictions. Or maybe it's due to confidence inspired by more widespread coronavirus vaccinations, but American consumers just do not seem to be as worried about the Delta variant as you might imagine from reading the headlines. Moreover, if we move on to the July employment report that we got on Friday, that data appears to back up a more optimistic view of U.S. economic health this summer. Not only did the Bureau of Labor Statistics report a 943,000 gain in non-farm payrolls, which was well above the 870,000 expected, but it also revised the past 2 months' payrolls numbers higher by over 119,000 jobs. That includes an 88,000 job increase in last month's payrolls, from the 850,000 that they originally reported to a 938,000 gain. So we've seen 2 straight months of almost 1 million new jobs added in the U.S. In addition to that, average hourly earnings, which is a widely watched measure of wage growth, increased 0.4% sequentially. That's more than expected, and they also revised higher the June data. Now you couple that with what's on this chart. This chart shows the Institute for Supply Management Services Purchasing Managers Index. So this actually shows, this is an indicator which a level of 50 indicates no growth. So if in the services sector of the U.S. economy, so if the reading on this index is above 50, it indicates expanding services activity, services industries. If it's below 50, it indicates contracting services activity. And you can see that ISM began publishing this data back in 1997. Okay? And what you can see here is that the latest monthly reading was for July. It was released last week, and it came in at 64.1. 2 things about that. Obviously, 64 is a lot higher than 50, so it's indicating very strong expansion in activity in service-related industries, which includes things like airlines, like restaurants, certain types of financial services, all in the services industry, right? But also, that happens to be the highest reading ever recorded on the Institute for Supply Management's Services Purchasing Managers Index. 64.1, higher than anything we've seen, even amid the late 1990s economic boom years. That is a white-hot reading if I've ever seen one. Now, what this makes me think is that, and the narrative supported here in my view, is one of above-trend economic growth, heightened fears about coronavirus, a lot of media hoopla about coronavirus, probably having an effect on the market this summer, especially because trading volumes are normally a bit lower in the summer. But the reality is much different than that. I am not seeing much consumer actual change in behavior due to the Delta variant outbreak, all the headlines about Delta variant. And in addition to that, I'm seeing very strong economic data. Now, this narrative, one of above-trend economic growth, rising inflationary pressures, and rising yields, which we saw on Friday, that's exactly the market narrative that would support renewed rotation back from growth stocks, technology, for example, into cyclical value shares, including sectors like the financials, energy, and industrials. So how are we going to play this going forward? Well, I can tell you this. As I said, being early is the same thing as being wrong. So I'm waiting for a few indicators to flip positive, and I think it's going to happen at some point over the next few weeks. In particular, I'm looking for market breadth to improve. This is the New York Stock Exchange cumulative advanced decline line. Simply put, when it's rising, it means most stocks are rising in value. When it's falling, it means most stocks are falling in value. And what you can see here is even though the market has made a series of fresh all-time highs, the S&P, since June 8th, the advanced decline line has not. Now, that's what we call a divergence. And what I would expect to see if the market wants to rally into year-end, and if we're going to see a rotation back into value stocks, I would expect to see this advanced decline line break to a fresh all-time high. You can see it started to make a move higher here off the mid-July lows, but we still have a ways to go to break out. And there's a number of other indicators I've identified, particularly in my Creating Wealth advisory, for when to know that it's time to actually start playing the upside in these value-related sectors. So a lot of investors have asked me, what am I doing right now? What am I recommending right now in Creating Wealth? And what we're doing there, we do have a number of long-side recommendations in the service. For example, we have some recommendations in cyclical groups, financials, industrials, and energy. And I'm actually looking to dive more into those sectors over the next few weeks. I'm also right now this summer recommending a lot of stock and industry specific ideas. For example, we recently recommended buying, and I mean by recently, I mean back in June, an industrial company that's actually spinning off one of its divisions. And sometimes when a company, and it just spun off, it completed the spin-off just in early August, sometimes, and in this case that's been the case, when companies spin off a division, it creates additional investor interest around both pieces, both the legacy company and the spin-off company. And it drives substantial outperformance from the stock, which is what we've seen in this particular instance. I'm looking at another company, and this is actually a European company that is scheduled to do a spin-off early next year. It's in a machinery industry. So it's in a cyclical industry, but it's a global company, even though it's headquartered in Europe, actually sells a lot here, right here in the US. And that's another name I'm looking at, more of a stock-specific trade. In addition, as I said, I am looking to dive more deeply into those cyclical value industries. In particular, financials and energy are two sectors I'm looking at very closely in that service right now. I have a couple of recommendations that I expect to add at some point over the next week or two. So if you'd like to see exactly what I'm recommending in this service, click the button adjacent to this video and start your risk-free trial of Creating Wealth Advisory. We're offering it this summer as a special flash sale opportunity at the lowest price we've ever offered, just $299 a year. If you decide that you don't like the service for any reason whatsoever, you have 60 days to cancel your subscription risk-free for a full refund. So this is an ideal first step if you're interested in figuring out how to make sense of this market we've had this year here in the US. So I hope you found that useful. If you're interested in creating wealth, just click the button adjacent to this video to start your risk-free trial, or call the toll-free number I'll throw up on your screen. Again, my name's Elliot Gu. I hope you found today's conversation about the market, some of the indicators and sectors I'm watching to be useful, and I look forward to talking to you again in the very near future.